Real Estate Investing for Beginners, written by Giovanni Ritters, narrated by Ron Garner. Introduction. Real estate investing can be very satisfying. It gives you the opportunity to work for yourself and independently make money on a consistent basis. It can also give you financial freedom and peace of mind while allowing you to work whenever you feel like it. You will never have to clock in or deal with office politics. You are not held responsible by a boss because you are the boss. However, real estate does require work and the competition is fierce. Nowadays, with information so freely available on the internet and in books, many people do not want to climb the corporate ladder and they would rather take a stab at real estate. Who blames them? No one feels like working 30, 40 years for a company with only 2 weeks of paid time off, barely making enough money to save for retirement. It's better to take matters into your own hands by investing in your future, and real estate is a great way to accomplish this. The new trend is to retire early and enjoy a somewhat stress-free life. Real estate can truly fulfill this promise. But just keep in mind, if you don't do it, then your next-door neighbor will. Chapter 1. Starting your real estate investing journey. The simplest explanation of real estate investing is to own, purchase, manage, rent, or sell real estate for profit. The goal is to put your money to work in real estate and then allow it to generate more money for you in the future. That is to say that the profit you generate from your real estate investment should be enough to cover the risk you take, including the taxes you pay and other costs that are associated with the ownership of real estate, such as insurance, maintenance, and property management. Real estate is one of the oldest and most reliable asset classes available to investors. Of course, that should explain why it is very popular in the finance and investment circles. Investing in rental properties is a sure way of generating steady income if you run your numbers, because the money or cash flow you receive in rent from your tenants can be used to pay off your expenses and is also used as a down payment to purchase new properties. In the United States alone, the cumulative worth of all homes in 2017 was $31.8 trillion. That was an increase of about 6.5% from the figures of the previous year. However, even though the benefits of investing in real estate are obvious, real estate investing is certainly not for everyone. It is for people that genuinely want to broaden their investment horizon. This is because it is surrounded by risk, which could result in investment failures. This could be a result of negative cash flow that is not sustainable and would often force the investor to sell the property at a loss or go into insolvency. Of course, that is why beginners are encouraged to gain as much knowledge as possible and also seek advice from professionals before investing. It's good to have connections with mortgage lenders, real estate brokers, a good attorney, contractors, and a tax advisor. A good real estate agent is a lifesaver. They can set you up with email alerts about real estate properties that meet your criteria. They also have good connections and knowledge on questions that you might have. Investing in real estate is one of the creative routes to diversifying your portfolio. So, if you love investing and at the moment most of your money is in the stock market, then this is the right time to explore the opportunity of investing in real estate because it offers the safest opportunity for diversification. When you diversify your investment portfolio, you spread out the risk. It will help to neutralize the risk of having all your eggs in one basket, which is discouraged by experts. Different types of real estate investments. One of the key factors that are considered in making investment decisions about real estate is the location of the property. It's really easy to figure out which areas are safe to invest in. Drive the neighborhood at night. Look up the crime statistics. Talk to people that live in that area and research amenities that people always look for when moving into an apartment or home in the neighborhood. Now, the other important factor that beginners are often not aware of is the fact that there are different types of real estate investments that they can invest in. This means that the people that are generating millions of dollars from real estate must be people that have devoted significant effort and resources to exploring specific niches of this business. That should also explain why you need to critically evaluate the different types of investment properties before taking the leap, because each of them contains benefits and pitfalls alike. 1. Residential real estate investment. This type of investment is probably the first thing that comes to the mind of most people when they hear real estate. Residential real estates are homes that individuals live in, and these include properties like residential houses, townhouses, holiday homes, condominiums, etc. In residential properties, your tenant pays you rent on a monthly basis to live in the property. Normally, the length of period in which they will occupy the property is noted in the rental agreement that is signed by you and your tenants. Most residential house leases in the United States last for a period of 12 months. Residential real estate can be single-family homes or multifamily homes. A single-family home is a typical American house that is surrounded by a yard, driveway, or a sidewalk and is often not connected to another person's house. Multifamily homes include duplexes, triplexes, and quadplexes. Such homes have several units in one building, which allows the landlord to potentially make more in rental income compared to a single-family home. 2. Commercial real estate investment. Commercial real estate investments include office buildings and skyscrapers. Such properties are specifically built for commercial purposes, and so you will not find anybody living in them. People who build or acquire such properties lease them to companies and small business owners who will utilize them for their commercial purposes. Of course, you will generate your income through the rent that is paid by those organizations to make use of your property. Unlike residential properties in America, whose agreement period is 12 months, companies that rent commercial properties may decide to get multi-year leases. This could lead to greater stability of cash flow, and it will also protect you when there is a decline in rental rates or an economic decline. Also, unlike the residential property where the buyer qualification will depend on the income of the person that wants to rent the house, the buyer qualification of commercial properties depends on the business qualifications of the buyer. Commercial properties have fewer buyers compared to buyers of houses because commercial properties require more money to get into, have less demand, depending on the location, and is often a lot riskier compared to residential real estate. 3. Industrial real estate investments. These are properties such as industrial warehouses, storage buildings, and distribution centers, which are built or acquired to be leased to firms. These properties are used by firms for manufacturing, production, research and development, storage, and distribution. Industrial real estate is a critical component of the global supply chain because of its role in keeping the world's goods moving from the producers to the markets. Industrial properties may not equal the amount of demand that is generated by residential homes and commercial properties, but it generates great returns from companies that make use of such facilities. Perhaps, to make up for the low demand, industrial real estate investments have significant fees and service revenue streams to increase the return on investment, or ROI. The location of the facilities is one of the most important aspects that need to be considered. 4. Retail real estate investments. Retail real estate investments consist of properties that includes retail shop facilities like shopping malls, strip malls, lifestyle centers, power centers, convenience centers, etc. Retail properties are constructed for the purpose of selling consumer goods and services to the final consumer. When you own or acquire such properties, owners of retail businesses use these properties for their business endeavors, and you will be paid rent from them leasing the property. 5. Mixed-use estate investments. This type of real estate investment involves the combination of two or more of the other type of real estate properties into a single project. That is to say, A particular building can serve multiple purposes, like a residential apartment and a commercial facility. That sounds amazing, right? It is a form of built-in diversification where you will have the opportunity to diversify within the different real estate properties you are interested in. If this is structured well, you will stand a chance of generating massive income from this arrangement. You may decide to have units of the building that are occupied by banks, retail stores, salons, restaurants, and even residential properties. 6. Real Estate Investment Trust, REIT. This is a type of real estate investment which you will not have to deal with the properties yourself. You make your investment through the REIT companies by buying the shares of a corporation that owns real estate properties and distributes its income as dividends. Even though a REIT does not offer a guarantee of profit or insure against a loss, it will offer you the opportunity to enjoy the potential advantages of property ownership, but leave the hassles of identifying, acquiring, and managing those assets of the REIT company. With a REIT, you have impressive risk-adjusted returns and a stable cash flow. You're also free to buy a REIT that will match your desired niche. That is to say that if you desire to own a retail store, a hotel, or a warehouse, you can easily search for real estate investment trusts which are within this specific niche or industry. Because of the strategic role of REITs in a real estate investment, a separate section has been dedicated to providing more detailed information about it. Chapter 2. Why invest in real estate? You might have already thought about investing in real estate and have your opinion on why you would want to start, or you might not have thought about it and would like some additional information about its benefits. So let's explore these. 1. Consistent income. Investing in real estate, particularly rental properties, is one of the sure routes to generate consistent, passive income for life. This is one of the reasons why the real estate market is booming. It is arguably one of the oldest asset classes, and it isn't going anywhere in the near future, because no matter what economic condition we find ourselves in, people will continue to live in homes and continue to patronize commercial properties for their personal, businesses, and industrial purposes. So, real estate is a strategic investment for people who desire to continuously generate income on their investments. The amazing thing about real estate investing is that you can start doing this part-time while still working a full-time job or focusing on your career. People who are actively involved in their full-time paid employment have the opportunity to introduce another stream of income. 2. The value of your investment will always appreciate over time. Over time, it has been noticed that the longer you hold onto your real estate, the value of your property will continue to increase. That is not to say that there are no bleak times in the real estate market, but repeatedly, we have seen that investors that held on to their investments during those sad periods recorded heavy returns when the market stabilized. So, with an investment in the real estate market, you will be certain of generating good returns on your investment because your property should always appreciate. 3. The use of leverage to achieve greater returns. The use of leverage for the purchase of properties with good rental yields is a way of achieving greater returns on your investment. You can leverage OPM, other people's money, to purchase properties. Getting approved for a loan from the bank to buy property is one example. Another example of using leverage in real estate is to leverage other people's time and knowledge. There is a ton to learn about real estate in any market, and you don't want information paralysis of analysis. It's therefore good to partner with people such as real estate brokers, attorneys, property managers, etc. They are experts in their field and will make your investment journey a lot less stressful compared to if you had to do everything yourself. Also, you can leverage your time by making use of REIT, where you will have the opportunity to own high-quality properties without directly controlling and managing the assets, and you will be sure that they are in firm control of professionals. 4. Perfect route to diversification of portfolio. You already know the reason for diversification of an investment portfolio: to reduce the risk of having all your eggs in one basket. And one of the best ways to benefit from this smart investment secret is to invest in real estate. As we mentioned earlier, real estate investments offer amazing opportunity to spread out the overall risk of your investment portfolio. Allocating assets and securities help to ensure a portion of your portfolio is performing well at all times. That is why adding a real estate investment in your portfolio will neutralize the volatility of other high-risk assets. This will help to reduce the level of risk on your portfolio and at the same time provide you with more stable returns. This should explain why the real estate market churns out thousands of millionaires annually, because it gives investors the opportunity to generate more consistent returns. 5. Numerous tax benefits. With an investment in real estate, you will be entitled to receive numerous tax benefits for the IRS, Internal Revenue Service. A real estate investment entitles you to several tax deductions like property taxes, repairs, maintenance, cash flow from investment properties, insurance and depreciation, mortgage interest, and other benefits which are deducted from your gross rental income, thereby reducing the amount you will pay to the government. There is also the case of tax-deferred growth, which is an indication that the growth of your investment is not subjected to tax immediately, but instead taxed down the line. That is to say that the capital gain you get from the increased value of your property will not be taxed until you sell it. 6. Offers protection against inflation and market volatility. The real estate market is known to be more stable than the stock market because the real estate market lacks the daily volatility of stocks. Also, as a long-term investment, real estate acts as a hedge against inflation. This is because the value of the properties over the years increase at a rate that equals the rate of the inflation. This will help to maintain your standard of living and also serves as a reliable platform to invest your retirement savings. This also goes for the rent you charge your tenants. You can increase this also, but make sure to keep it in pace with rental rates of similar properties in the neighborhood. Chapter 3. Real estate investing while working full-time. Participation in real estate investing does not mean you will have to quit your full-time job. The reason for this is simple. There are different types of real estate investments that give you the option to outsource the day-to-day work to a property manager or a contractor. So, the decision you make and the strategy to fulfill your desire to have profitable real estate properties depends on you. So many people think that in order to become successful in businesses and investment, you will need to quit your job and pursue the business or investment as your full-time career. But that is not always the case, especially for real estate investments. There are a variety of options which will match your lifestyle, experience, education, and financial muscle. Here, you have the option of becoming either an active real estate investor or a passive investor. As an active investor in properties, you need to quit your full-time job because you will need to channel your full attention to ensure that your investment is successful. These type of investors are independent contractors whose major resource of income is their investment in real estate. Unlike the employee, these set of people are responsible for calculating and filling their own payroll taxes on a quarterly basis. Also, active investors may experience slower growth because the income generated from the investment will also be used for living expenses. But then, they do have all the time to manage their properties in a way that will make it profitable for them. And since it is their primary source of income, they will have the opportunity and the time to own and manage as many properties as they can afford. On the other hand, the passive real estate investor is a full-time employee who desires to create a new income stream by investing in real estate. Unlike the active investor, the passive investor does not need to quit their job to benefit from the real estate market. If you desire to be a passive investor, you need to search for the type of investment and the investment strategy that will suit your employee lifestyle and your economic situation. Of course, there are several options available. A passive investment strategy comes with numerous benefits. Notably, you will have a job that will take care of your living expenses, while the returns you make from your investment can be reinvested. You may also have the opportunity of saving more money from your job to acquire more real estate properties. Keeping your job will also give you the opportunity to access bank financing, as you could easily get a loan from the bank by showing proof of your income. Also, unlike the active investor, your investment will only require little time, such as researching and identifying properties, calculating cash flow, and managing the property, because you will more than likely have to use a property manager, contractors, and a real estate agent. Finally, another benefit is that both the passive and active investor will benefit from several tax deductions. Just make sure to document all your real estate expenses, which you can claim on your taxes. Financing a real estate investment. Perhaps you earn a little amount of money, and you are not certain it will be enough to acquire properties that will position you to benefit from real estate investment opportunities. You are not the only person in this situation, and this book was written to educate you on how to creatively overcome that limitation. 1. Bank loans. Getting a loan from a bank is one of the traditional means of financing a real estate property. This is also the path that many beginning investors take when dipping their toe in the market. Like you already know, assessing a bank loan comes with its own stressful steps, but it is worth it, just for the fact of going through the steps to see what a bank looks at in order to get you approved. In recent times, because of the stringent conditions attached to bank loans, experts encourage beginners to seek for loans at local banks or credit unions with flexible conditions instead of national banks. To access a loan for real estate property, you will be required to get pre-approved at your bank. Previously, a pre-qualification was a first step you would have to take, but recently, getting pre-approved has become the standard. After this stage, the bank will need to undertake an evaluation of the property, and if it is approved, you will go ahead to sign a contract of sale. There are important requirements which will qualify you to access a real estate loan, and they include: A. Down payment. Most banks will require you to make a down payment of about 20% of the cost of the property, as one of the requirements to get a mortgage bank loan. In most states, you might have to put down 25% if you are buying an investment property you will not live in. If you can put more than 20% down, you can get a lower mortgage, which will allow for a lower monthly payment. If you have a good or great credit score, you can also qualify for loans that allow you to put less money down on the down property. B. Credit score. The bank considers your credit score before you will be granted access to real estate loans. Even though the minimum score of 620 is required, if you have a higher credit score before applying, you will be entitled to lower interest rates. C. Debt to income ratio. To increase your chances of getting approval for your loan, you will need to have an impressive DTI. Your monthly debt to income is calculated in order to decide if you will get approved for a loan. 2. Private money lenders. This is a great way of financing your real estate property if you don't have the money for a down payment and if you will be unable to meet the other requirements for a bank loan. These loans are not given by traditional financial institutions, but rather individuals and businesses who are interested in financing investments to get a certain return on their loan. A good number of private lenders use their retirement nest egg to find real estate projects. However, these types of loans more than likely carry a higher interest rate than a bank loan. Working with a private money lender is also faster than trying to get approved by the bank, as you don't have to go through an evaluation, paperwork, and unnecessary delays associated with bank loans. 3. Partnership. Getting partners in real estate can also help if you are pooling your money. This is a creative way to acquire properties. Just be sure to structure the partnership in a way that everyone brings something to the table. If not money, it needs to be skills or knowledge. With the partnership, you could easily access loans, financing, or you may even have partners that will have the financial means to fund many investment properties without you having to bring much money to the table. In such a situation, you must be careful to ensure that the goals, roles, and returns of the investments are properly discussed and agreed to avoid any issues among the partners. It's best to set up something in writing. 4. Owner financing. Now, this is an interesting way of financing real estate investments that not a lot of investors take advantage of. With owner financing, the owner of the property you want to buy can finance the purchase of the property, and you will then make your monthly payment to them rather than a bank. Although there are conditions attached to this form of financing, such as the seller needs to already own the home, which means there will be no existing mortgage on the property to prevent foreclosure. So, if the conditions are right, it is a great way to escape the stress that is attached to getting the bank loan. 5. FHA loan. If you are planning on living in your investment property, you should take a look at taking advantage of getting a mortgage insured by the Federal Housing Administration, FHA. FHA loans allow you to have up to 4 separate units as your investment property. That means you can acquire a multifamily property with about 4 units, where you will live in one unit and rent out the 3 remaining units for rent. With this, you will generate rental income and at the same time live in a rent-free apartment because the tenants in the other 3 units are basically paying off your mortgage loan. Another benefit of the FHA loan is you will need to make a down payment of just 3.5% of the total cost of the property, compared to the 20 to 25% down payment that is required to access bank loans for investment properties. 6. Asset-based mortgage. This serves as an alternative method of financing investments to traditional bank loans, and it is very flexible. If you don't have a stable income, this might be the correct financing option available for you because personal income is not being factored in. Basically, they look at the rental income the property will produce. 7. Funding from family and friends. There is also the option of financing the acquisition of your real estate investment through the funding from your family and friends. If you go to real estate events, you will get to meet different people who got their start in real estate by reaching out to their family or friends for financing their first or even second deals. So, if you have a cool uncle or an entrepreneurial neighbor, you could talk to them in funding or financing your real estate. Going into business with friends or family is always a touchy subject, so make sure you don't burn any bridges, don't lie, and stay ethical. Chapter 4. Should you invest in REITs? REIT, which is an acronym for Real Estate Investment Trust, refers to companies that own, operate, and finance income-producing real estate and are afforded special pass-through tax deductions. REITs are modeled after mutual funds because investors are required to pool their funds together to acquire and manage residential and commercial properties, in which the company collects rents from the tenants of the properties and then passes the income to the investors in the form of dividends. REIT was created by the United States Congress in 1960 as a way to give individuals the opportunity to own and finance properties the same way they invest in other industries through the purchase of stocks. Basically, after paying the expenses associated with operating their properties, a minimum of 90% of the taxable income generated by these companies are shared as dividends with the shareholders. That's the reason REITs are not required to file for corporate income tax. To investors, it is an investment vehicle that helps them to escape the hassles that are associated with the process of identifying, operating, and financing real estate properties, because these responsibilities are undertaken by the REIT companies. For investors who are working full-time and do not have the time to personally handle the process of investing in real estate, this is a wonderful opportunity to benefit from the large real estate market. Types of real estate investment trust. There are two major types of REITs: equity REITs and mortgage REITs. Equity REITs. These are real estate companies that invest and operate in a particular type of property in which they lease out to tenants who pay rent. After paying of the expenses that are incurred in the course of operating the properties, equity REITs pay a huge proportion of their annual returns as dividends to the shareholders. This is in addition to the capital appreciation from the sales of the properties. There are many equity REITs, and they are typically found in all niches of real estate investment. There are retail REITs, which invest in shopping centers, malls, and other retail outlets, and also residential REITs, with investments in single and multifamily homes. There are also industrial REITs with investments in warehouses, storage, and distribution facilities. Mortgage REITs. Mortgage REITs are companies with investments in real estate mortgages or mortgage-backed securities. These companies earn income from the interest on the mortgages and also on the sales of the mortgages. The mortgages can be agency mortgages, non-agency mortgages, or commercial mortgages. Most mortgage REITs invest in either residential or commercial mortgages, although in recent times, some companies now invest in both of them. Just like the equity REITs, the mortgage REITs share a huge proportion of their annual income to their shareholders in the form of dividends. The dividends is paid out of the earnings of the company. Why should I invest in REITs? If you are still on the fence when it comes to this asset class, then consider the following benefits of investing in REITs. Higher income. If you invest through REITs, you will be sure of generating a higher income in line with revenues generated from rent payments or property sales. Of course, you are now aware that about 90% of the total taxable income of the REIT will be distributed as dividends to you as a shareholder annually. Higher than the market. Over the years, reports show that the amount of income generated from REITs exceed the amount of returns people get from investing directly in the stock market. So, if you need higher income, REITs are a sure thing. No hassles. REITs are an extremely convenient investment vehicle. With REITs, you don't need to bother yourself with analyzing properties, making sure your credit score is high enough, or doing the legwork of making connections in real estate. All you have to do is buy a REIT you're interested in and hold onto it while collecting the dividend. Ways to invest in real estate. Let's explore some of the different ways we can invest in real estate. Below are answers to some of the topics beginners in real estate investing have questions on. We also go over the different ways many successful investors have started. 1. Rent out a room in your home. This one works for people who already have a home. One of the easiest ways to make money from real estate, and it is also a good step for beginners who are yet to fully make up their minds about real estate investing. So renting a room of your home will be a nice way to test the waters. You would do this by renting out a vacant room in your home to a tenant or another living space like your garage, basement, driveway, or an outbuilding on your property. If you are yet to get your first house, you can decide to buy a duplex or even a triplex, where you will be able to rent out unoccupied units of the property. If your home is located in a good area and you have a good space to rent out, you will have the opportunity of making extra income from it. 2. Buy a rented property. Another way to generate great cash flow in real estate is to purchase a property like a single-family home or a condo and rent it out to tenants. To get the maximum benefit out of your investment, you need to ensure that the combined cost of the monthly mortgage payment, home insurance, property tax, and secondary expenses are lower than the rent you charge for the home. Buying a rented property usually requires a large deposit, from a down payment to maintenance cost. Therefore, you will need to be sure that the total expenses you will incur from the property is lower than the amount you will rent it out for. 3. Flipping houses. Flipping is what most beginning investors think about when they hear real estate. This can be a fast way of making money if you know what you're doing. Flipping houses is the process of buying a property that needs an update or some remodeling with the hope of selling it at a higher cost than what you bought it for and the amount of money you put into it. So, because the property needs a serious rehab, you will negotiate to buy this property far below its market value. This is an interesting way to invest in real estate because not only are you rehabbing the property to increase its value, you are also aiding in increasing the value of the neighborhood, making it a much more pleasurable place to live. However, flipping is also very risky if you have no experience because you may find out that you end up putting far too much money in rehabbing the property and won't be able to sell it for a profit. Therefore, if you want to start flipping homes, you will need to write out a detailed assessment of the cost of fixing up the property and compare that to the amount of money you will sell the property for. Keep in mind that it's always a good idea to find a mentor if you're having trouble calculating how much money you need to put into a rehab in order to still make a profit. 4. P2P investment platforms. There's also the opportunity to benefit from the real estate market through peer-to-peer investment lending platforms. This strategy involves a group of investors pulling funds together through crowdfunding to acquire specific real estate-related investments. With such platforms, you will have the opportunity to invest in different types of real estate, where you will have more control over your investment compared to REITs. You will also have the opportunity to diversify using a small amount of money across different properties, which means with the little money invested, you will be among one of the owners of a variety of properties. 2 examples: Fundrise.com, PeerStreet.com. Number 5. REIT. Another passive way to invest in real estate is to REITs. Real estate investment trusts come in different shapes and sizes. In order to invest in a REIT, you need to have a brokerage investment account, which will allow you to purchase shares in REIT companies, as these companies trade on the stock market. 3 examples of REITs: Realty Income, WP Carey, Omega Healthcare Investors. 6. Real Estate Limited Partnership. The limited partnership is similar to the REIT and crowdfunding, but it has its peculiarities. If you adopt this strategy, a general partner will handle the direct management of the properties held in the partnership, while you and other partners are only involved in supplying the capital. It is a form of limited liability because your profits and losses are limited to your actual investment. Just like a REIT and crowdfunding, LP will give you the opportunity to invest in bigger and more expensive properties, which you may not have been able to acquire as a single investor. Chapter 5. Fear and Doubt of Investing in Real Estate. There are numerous reasons why many people shy away or procrastinate in taking any actions in starting their real estate journey. Don't let this be you, because you don't want to live a life of regret. If you are reading this book and are still on the fence about real estate, I will try to help you get over your doubts by focusing on what I've seen other investors go through and how they overcame their situations. Let's take a look at some of the most common setbacks of real estate investors. Fear. It is understandable that nobody wants to lose their life savings in an investment they are not sure of. That is the main problem with many people who have yet to take the first step. This fear could be a result of the uncertainties surrounding the real estate market, like instability or not having enough knowledge about the local market you're in. But the truth is, no investment guarantees a 100% stable outcome, not even the stock market. The best we can do is to make sure we do our due diligence before buying a property by laying out our projected expenses versus income. So even though real estate investing does bring with it a certain amount of risk, it's still one of the more stable asset classes to make consistent money with. Not enough money. Most real estate investments involve a large amount of money, either for a down payment or buying a property outright. Therefore, people without savings or a consistently high paycheck are always scared to take the leap. However, if you carefully read through the section on financing real estate investments, you will discover that there are multiple financing options available to you to acquire properties. I have met real estate investors who started investing with no money of their own. These investors took the road of partnering with private money lenders. The task of becoming a landlord. Some people are not ready to face the task of becoming a landlord and the challenges that come with it, which is why they are scared of investing in real estate. Granted, that for you to be a landlord, you will need to pay attention to the needs of your tenants and several responsibilities that come with that position. But that is not a good enough reason to deny yourself from doing real estate. One option is to hire a property manager to manage the property for you. It's very important to interview a couple of different property managers in your area and get their property management fees to see which one would work best for you. The decline of property value. There is nothing worse than doing your due diligence on a couple of properties and deciding on the best one to buy, only to find out that the value of your property has declined. Now, this is the reality of all investments, and real estate is not an exception. However, historically, the real estate market has always bounced back from a decline and has been able to grow and keep up with inflation. Just take a look at the market crash we had in 2008. Even though prices in the housing market fell, they quickly picked back up. No education. A large percentage of people who are scared of investing in the real estate market are people who lack sufficient knowledge about the market. Some of them rely on information and predictions of pseudo-analysts who are without experience and proper knowledge of the market. Continue to educate yourself on real estate. Read different books to get different perspectives on real estate. Visit different real estate seminars, and don't forget to watch videos online. That being said, there will come a time where you will have to act. You don't want to only become knowledgeable on real estate and still procrastinate. Inexperience. Lack of experience is also part of the reasons why some people are scared of investing in real estate. But then, you don't gain experiences by becoming scared of what you're interested in. A good way to overcome inexperience is to leverage the knowledge of people in real estate you can make connections with. A good real estate agent should be on your speed dial. He or she can give you some great insight information on your real estate market. A great real estate agent also has many connections with people in the business. If you are looking for property managers, contractors, or even attorney, it's best to start asking your real estate agent. Conclusion. Becoming a millionaire real estate investor will take time, but it is worth it. Not only can you generate passive income in the form of rent payments, your investment properties will more than likely also go up in value. And better yet, you own something of value that you can pass down to your family or kids. Real estate investing does not have to take up all of your time. It is also best to start while you are still employed, because you have income coming in for unexpected costs that might rear its ugly head. It is normal to be hesitant and cautious when jumping in the real estate world. So, it's very important to educate yourself and get a real estate agent who can give you good advice. Once you start buying more properties, your debt-to-income ratio will make you a high-risk lender to the bank if you've been using bank loans to buy properties. This is when you will have to switch over to creative lending sources like private money lenders, portfolio lenders, etc. Always remember that for every setback you might come across, there has been an investor who also came across this problem and was able to solve it. For every real estate problem, there is a solution out there. Don't forget, real estate investments are a great way to diversify your portfolio. Thank you. I would like to thank you from the bottom of my heart for coming along with me on this real estate journey. There are many books out there, but you decided to give this one a chance. If you expanded your knowledge by reading this book, then I need your help. Please take a moment to leave an honest review for this book. This feedback gives me a better understanding on the kinds of books and topics readers like yourself want to know more about. It also gives my book more visibility to potentially new readers. Leaving a review takes less than 1 minute and is much appreciated. Other titles by Giovanni Ritters. 50 Tips on Saving Money. Ever have a feeling that you never have enough money when needed? Would you like to have some extra cash to buy what you feel like? Well, in this book, we will look at 50 different tips allowing you to have some extra cash in your pocket and bank account. Stock market investing for beginners and dummies. It's time to start building wealth, and learning the basics on stock market investing will put you on the right path. Real estate is a great asset class to start with, but you can definitely combine it with stock market investing. I begin with the basics, like what are stocks and how stock market works. I then transition into how you can make money in the stock market, give you some stocks you should have on your watch list, and some of the lies and mistakes you will have to deal with as an investor. Important disclaimer. This book is presented solely for educational and entertainment purposes. The author is not offering it as legal, accounting, financial, investment, or other professional service advice. The content of this book is the sole expression and opinion of its author. It is not a recommendation to purchase or sell equity, stocks, or securities of any of the companies or investments herein discussed. The author cannot guarantee the accuracy of the information contained herein. The author shall not be held liable for any physical, psychological, emotional, financial, or commercial damages, including, but not limited to, special, incidental, consequential, or other damages. You are responsible for your own choices, actions, and results. Please consult with a competent tax and/or investment professional for investment and tax advice. The end.